Let's talk about how you can make about 1% or 0.5% or even a bit more on CL short puts following the Trump and Putin meeting. So I would probably sell short puts on crude oil for a few reasons. The Trump and Putin meeting didn't really yield anything surprising, and price has been moving down for about 2 weeks. So this is a pretty good entry point. Now, just a reminder, crude oil crashes upwards. So if there's anything crazy happening, it will rise in price and not go down like stocks or the S&P does. So commodities, they crash upwards. Now, for the position management, I will probably take profits at 50% of credit. And the most important thing for risk management, I will sell the futures contract if the price reaches the puts, or you can roll the puts much earlier, which is probably preferable to do before you sell the future itself to protect yourself. Now it depends, everyone's trading a bit different. Now the absolute non-negotiable rule here is you have to keep position size small, 2 to 3 put contracts per every $100,000 in the account. And this is because, if it's a small position, you can definitely save it by rolling, by selling the future, by doing many different things with options. Which we know, people can be really creative with options. But if the position is too big, if you want 10 contracts, sure, you can make a lot of money. But at the same time, if things go sideways, you have absolutely no way to protect yourself. So this is just kind of hoping things will be fine. And which is, this is not a strategy. It's not going to work long term. I think it's been proven quite a few times. So currently looking at the crude oil futures at November expiration. This is what the graph looks like. So to be really safe, I will probably go and sell the strike 50 put on the November contract. We have quite a big distance for the price to be, able to get all the way down to strike 50. Let's see how much is it in percentage. Probably, let's see here, what is 61 to 50. So we're looking at about 18%. So that's quite a big drop. If the price drops that low, it means the economy, it's either doing really good or the demand is slowing down. And usually when the demand slows down, OPEC will cut their production to keep the price of crude oil pretty range bound. So unless something insanely good and crazy happens, price will not drop to strike to $50 on crude oil. And even if it does, we have a small position, so we can manage it easily. Now on Interactive Brokers, it translates to the cycle with 60 days to expiration, so October, November, and strike 50. Let's see what we can get in credit. I believe it was about $500 of credit per contract. So on Interactive Brokers, it shows you the lower end. So it's probably going to be, the mid price is $490, so probably about $490 per contract. So you can take 2 or 3 of these contracts. So if you take 3 contracts, you take profits at half of the amount. You'll be making about $740, $730 after fees, which brings the probability of profit from 94% to a bit over 96% actually. So not bad at all. And you should be in the trade according to the theta for no more than 20 days, unless again if the price drops, obviously it's going to be a bit different. But if the price drops, theta also increases, and theta is also going to speed up because we're at the 60 days to expiration. We're close to 45. Now this is just an idea. Some people can probably go to 31 days to expiration and do something similar, but the point being here is fundamentals are pretty good, and price is really unlikely to drop to strike or to strike 50, which is where we are selling options, and even to strike 55 to be quite honest. But 50 is just to play it extremely safe, which is what I like to do. So this is it for the weekly trade idea. Should be a pretty high probability trade. If you have any questions, let me know in the comments, but should be pretty straightforward. Thank you again, and I will catch you in the next one.